If you are a current homeowner or perhaps wish to buy your first home in Singapore in the new year 2023, you may just be covering your eyes whenever you hear of the continued rise in mortgage rates as a result of the U.S. Federal Reserve increasing interest rates. Now, should you wait till interest rates come down? Or could you be caught out as there are fears rates could continue rising to curb inflation?
All right, so many questions and more. Let's bring back Alan Cheong. He's the Executive Director at Savills Research. Savills is a global real estate services provider. Hey, Alan, these mortgage rates are at levels not seen in 15 years. How are Singaporeans reacting to this changing market, this changing housing market? The Singaporeans you spoke to, that you researched as well, and these changing housing market trends along with the recent cooling measures as well.
All right. Thank you very much. And I think on the interest rate front, we don't seem to be seeing or feeling that effect on the new sale market. But it is in the resale market that we saw transaction volumes falling off the cliff starting from around August this year. So, but, in the same breath, I can't really say that the resale market is affected by interest rates because there are buyers are moving to the new sale market because they have been educated by the agents that you don't have to pay so much upfront and so save on interest expense until later on down the road.
So, Alan, are you saying that house prices are sort of resilient? They've remained steady. Are we seeing perhaps maybe a slight drop in prices because of what's happening, maybe to entice people to buy? Some of these prices have come down over the past few weeks.
Not really so. In fact, prices are still holding firm and contrary to some belief, it's actually still rising. It's only in the transactionary volumes that in the resale side that has fallen off the cliff by more than 50%, in some cases 70%.
And what would you say about the resilience of the housing market?
I guess it has to do with the amount of liquidity in the system. And this liquidity is not just the buyer's own savings account in there, but it's also heavily dependent on the buyer's parental savings. So you can draw on your account and you can draw on the previous generation savings. That's where, we could possibly dodge this bullet on this interest rate increase front.
Hey, Alan, would you say maybe the rich may have fewer problems paying the higher interest rates? So will people in the middle to lower income bracket and perhaps young couples, they're just starting out, feel that interest rate hike more so?
The interest rate hikes will probably be affecting those who want to buy for investment, and property taxes would affect people more for those across the board who bought for both investment and bought for own use. So the property tax, I think, has a greater impact on what's happening across the residential landscape. Now, I'm not saying that it will tip the market down, but it is adding a break to people's decision to buy real estate. But I guess at the end of the day, it's just deferring the purchase, and it's not going to stop this age-old belief that real estate is a good long-term investment.
And a lot of investors and home buyers are worrying too, more the home buyers, because as countries fight inflation, interest rates could continue going up. So what should they bear in mind as we head into 2023?
So interest rates are likely to go up, but it won't go up for too long. At one point in time, interest rates will likely inflect, as in the Fed will probably pivot. And when it starts pivoting, markets are built on expectation. People look at declining interest rates as more of a reason to buy rather than the absolute level of interest rates. Because at today's level, even if you raise interest rates by another 50 basis points here, mortgage rates in particular here, I believe that there is still demand out there this correlation about interest rates to real estate prices maybe works 20 years ago, but with so much liquidity in the system, especially amongst households, we could easily overcome this interest rate increase by borrowing less. So this is where I think the one doesn't know how deep that liquidity level is.
We know Savills is more upmarket and handles more well-heeled clientele. Has foreign investor interest remained solid when it comes to buying Singapore property?
The foreign investors have always been interested in Singapore real estate. Now, I think the big moves already happened in 2021 and into the first quarter of 2022. But after the, over time, because of this 30% increase in on ABSD for foreign buyers, we find that only those who are, inverted commas, more desperate to buy private residential real estate here, those who are not PRs or foreigners, then those numbers are still there, but it's pretty low. So the interest is definitely there. If there had not been ABSD, I'm sure all the unsold stock or new sales stock in the luxury segment of the resale market will be pretty active in the across the island.
Yes, indeed. But what of the rental market? Will we see rent staying high as demand outmatches supply as more people come back to Singapore post-COVID?
We think that the market will only resolve itself, i.e. the rental market, in about 15 to 18 months' time. From what we gather on the ground, there's still a lot of interest. People are now looking at rental properties before they even online, before they even get here, physically. So that's really, unlike 24 months ago, you could view 7-8 properties before you make an offer. Today, you see the first property online, you better make the offer. So that's the situation now. So it's still pretty tight despite all this talk about tech layoffs.
Thanks, Alan, for joining us on Singapore Today. Alan Cheong is the Executive Director at Savills Research. They're a global real estate services provider.